All right, well, thank you, Wayne. And so Megan, let's go ahead and jump into the next section of our presentation. And, here I can assure you, we will not be talking about sex and we will not be talking about greed because we're going to be talking about a 10K and some of the information that goes into the 10K. And so there's been some significant changes in the last couple of years that we want to make sure everybody's aware of. So I've got a number of bullet points to go through. So I'm going to ask your forgiveness early as I run through these. So please fasten your seatbelt because we will go through these items fairly quickly to keep us on track with our agenda. So I think the best way to look at these 10K changes is really put them into two different groups. We had one group of changes that went effective for last year's 10K. So if you're a calendar year-end company, these changes were required in your 2020 10K. And now we have the second group of changes for the 10K. They're going to be required to be implemented in this year's 10K. So first, let's go ahead and take a look backwards and let's look at what should have been implemented last year. And let's just make sure that we're clear on those requirements. You'll see on the slide, there's 3 bullets, and they are human capital management disclosures. They are some revisions to risk factors, and there is some new guidance on the business section and legal proceedings sections in your 10K. So a couple words on the human capital management. This, I think, was probably the most squishy of them all, but this was the requirement to include a description of human capital resources and human capital measures or objectives that a company might focus on in managing its business. So for example, how do you attract, develop, and retain personnel? And I think especially today when we're all experiencing the Great Resignation, there's a high degree of turnover in most businesses. There is some issues in terms of hiring qualified folks. So this is certainly relevant for today. So there was actually a survey done this year on the S&P 500 companies in terms of what type of maybe new human capital metrics they were disclosing in their 10Ks. So what can we learn from the trends? And the survey showed that companies were disclosing things like your geographical distribution of employees, the breakdown of types of employees, full-time, part-time, seasonal. What steps have been taken to identify, recruit, and retain new and existing employees? Diversity statistics, and what are the company's commitments to diversity and inclusion? Of course, employee incentives and benefits, employee safety measures, and employee engagement surveys. So those are all things that S&P 500 companies are disclosing around this human capital measurement requirement. Right now, it's largely principles-based, so there are not prescriptive rules in terms of what you have to disclose outside of the number of your employees. But it's going to be interesting to watch now because, as you know, there is now a Democrat at the head of the SEC. So again, there's 3 Democrats, there's 2 Republicans on the SEC. So some folks are speculating that we might get more prescriptive rules in this area prospectively. So we'll keep an eye on that. But let's make sure that we are including those human capital disclosure requirements. Risk factors. So risk factors was new last year. So what did we do to the risk factors? Well, what the SEC is trying to do is really streamline the disclosures here. So there's a new rule now that says if your risk factors are more than 15 pages in length, we want you to include a summary. So you've got to include a little bit of a Reader's Digest version or an executive summary of those risk factors. So the SEC is trying to motivate us to keep those risk factors short, keep them under 15 pages. And again, if you don't, you're required to list a summary there. The SEC is also telling us, please tailor general risk factors specifically to your company, or just place them underneath a general heading. So again, they're trying to go with specific disclosures, not general risk factors that quite frankly can apply to any business. Of course, this is going to create some interesting conversations with your securities counsel. In our experience, securities counsel tend to like to throw everything but the kitchen sink in the risk factors. But again, the SEC is advising us, hey, let's be real specific with these risk factors. The third change that we had on the risk factors was to use some headings to organize them. So the risk factors should be presented in an organized manner. So maybe we group them as how these risk factors relate to our business, Maybe we have another grouping for how they relate to our industry. Maybe we have another grouping how they relate to the ownership of our stock. But again, we want to organize them properly. There's a couple of warnings that the SEC has given here, and they've made some cases out of a couple companies. So one warning that the SEC has given us is beware the hypothetical disclosure. So sometimes a risk factor would say we may have a security breach, or a security breach could occur. And the problem arises when those events have already happened and you're positioning your risk factor in a more hypothetical sense. Yahoo is the poster child for this one. Yahoo disclosed something like there may be a risk of data breach when they actually already had one. And the SEC fined them a handsome $35 million for that. So we want to be aware of that. The other warning the SEC has given us is beware of the COVID-19 disclosures. We are now well into COVID-19, and so the SEC is advising us that the disclosures here should be robust and specific. COVID-19 is no longer a novel consideration from a disclosure perspective, so we need to be real specific. One company's already gotten in trouble for this, and that is the Cheesecake Factory. This is all public information, so if you wanted to look at an interesting case, look at the Cheesecake Factory. When COVID hit and they went to a delivery and a to-go model, they made that transition appear much more rosy than it actually was. The company was losing a lot of money, and they didn't really disclose the stress on the business. And so they ended up paying a fine to the SEC. And that was, I think, the first COVID-related enforcement action that we saw. The last item here is just on the business section. And quite frankly, there's not a lot of new information here to pass on to you. One thing that is worth mentioning is the legal proceedings section. And again, the SEC is trying to streamline. So let's make sure when we go to legal proceedings, let's take advantage of the opportunity to use hyperlinks and cross-references. So I think a best practice would be to do a nice description, maybe in the footnotes to your financials of the legal proceedings, and then we can reference into the 10K and maybe even the MD&A where it's relevant, or maybe the risk factors where it's relevant. But we are allowed to use cross-references and hyperlinks now. So that's a nice benefit. Let's go to the next slide, and here's a couple of improvements for 2021. And again, the theme here is going to be on streamlining and making the document a little bit more easier to digest. So we're getting rid of a couple things, which is really nice. So right now, if you are not a smaller reporting company, you're required to include a financial data table that goes back for 5 years. So we're getting rid of that. All that information is readily available, so there's no need to duplicate it here. And also, if you're not a smaller reporting company, you're required to include in your financial statements a disclosure of your quarterly financial data. So the SEC asks you to print your revenue, your gross profit, your net income by quarter. And so again, that's information that's readily available to most investors. So the SEC says, let's get rid of that. So 2 items that we're getting rid of there. The big changes for this coming up year are all about MD&A. And Megan, if we can go to the next slide. So we have what we'll call a new and improved MD&A. Again, we're going to eliminate some of the disclosure requirements that are in MD&A today. So that contractual obligations table that shows our contractual obligations going out over the next 5 years and thereafter, we're getting rid of that. The section for off-balance sheet arrangements, we're getting rid of that. Although the SEC warns if any of those, the off-balance sheet arrangements, the contractual data table, if that information is important to users, please include it in your MD&A. Critical accounting estimates. It might surprise you to know that that is actually not in the SEC rules right now to include critical accounting estimates. Most every public company discloses them. So it is now official and it is now required, and it's in the SEC rules. So that was added. The SEC is going to focus on known trends and uncertainties. This is an emphasis point in MD&A. So what are the known trends and what are the uncertainties in your business that might change your financial picture going forward? So they're going to emphasize that area. Probably the most important one, and I think the one that's most interesting, is how we present the MD&A, the results of operations section. So today, as you might know, the requirement is to present really quarter over quarter or year over year. So we'll look at this quarter versus the same quarter last year, the year-to-date period this year versus the year-to-date period last year. The SEC has given us an option now. So we can continue to do that. Or the SEC says if you'd prefer to run your results of operations comparison based on sequential quarters, you're allowed to do that. So if you wanted to compare this quarter, not to the same quarter last year, but to the immediately preceding quarter, we're allowed to do that now. So that's something you probably want to talk about in your company and see if you want to avail yourself of that option. There are some transition requirements if you choose that, so be aware of that. But it could, especially if you're a rapidly growing company and comparing Q1 of this year to Q1 of last year means nothing, why not do a sequential quarter over quarter presentation? That might be more useful for the investors. So that's a big change, and I think probably one of the more interesting ones. Megan, let's jump to that polling question real quick if we could. And so we have a polling question just to check the temperature in the room. If you think about your own company's 10K, what do you think of the length of the document? Is it too brief? Do you think it's too voluminous? Or do you think it's Goldilocks and it's just right? So we'll give you a second to think about that. And Megan warned me, she said, hey, you better have something to talk about while we're going through the polling question. And I was hoping to find some data on the length of 10Ks. And the best I could find was a Wall Street Journal article from a number of years ago that said the average 10K had about 45,000 words in it. And this is about the maybe 2015, 2016, the study was done. So about 45,000 words in the average 10K. And just as a reference point, the book, The Great Gatsby, has 49,000 words in it. So it's about reading an average 10K is about the equivalent of reading The Great Gatsby.
So you should be seeing the results, Rick. Right?
Yeah, and I think, nobody voted, very few people voted too brief, which we'd expect, and voluminous. And so again, I think some of the stuff we're talking about today is really meant to cure that. The last slide we have, Megan, if you can go here, the last slide is just a couple other of helpful hints as you work through this 10K season. One is just be aware of SEC comment letters. There's lots of folks that comment and write articles on what the SEC is reviewing. This helps you because you know what the SEC is focused on, and it helps you understand what companies are having trouble with. The number one area of SEC comment letters for 2021 was non-GAAP financial measures. And so be aware of that. And again, this information is publicly available, but it's a good practice to read through it. A popular term that we've been hearing a lot lately is something called director overboarding. The proxy advisory firms, ISS and Glass Lewis, are promoting and they're monitoring how many boards your directors are serving on, and they've come up with some metrics. So for example, if you're a director, these advisory firms say you really shouldn't serve on any more than 5 boards. And if you have a C title, if you're a chief executive or a chief financial officer somewhere, they only want you on 2 boards before they think it's too much. So just be aware this is an area of increasing scrutiny. The last item here, just on ESG, and we purposely didn't put ESG on too high of a platform today, but this is an issue that's not going away. It's a heavy emphasis area from the SEC. We are going to see some rulemaking from the SEC around some mandatory climate-related disclosure requirements this year. So the rules are being written, they are coming. So please don't think because you're a small company that this is not applicable to you. There's rulemaking coming this year, so we'll stay tuned for that.